welcome to the deep dive. So the big news, he gets it. The U.S. Federal Reserve, they've just cut interest rates.
That's right.
And this isn't just some distant economic headline. It's a signal, really, with ripples heading everywhere, especially towards India.
Definitely.
So today, our mission is to unpack what this first Fed cuts since, well, last December actually means for India's markets, the rupee, the RBI's own thinking, and that there are some really fascinating undercurrents behind the Fed's decision, too.
Yeah, and to do that, we're looking at insights from a Mint Explainer, some key analysis from the Economic Times, and also a breakdown from the Indian Express. Gives us a good overview.
Great. Okay, let's get right into it. The Fed's move a 25 basis point cut.
0.25%.
Bringing their benchmark rate down to 4.00, 4.25%. And crucially, this is the first cut this year. Breaks that pause they started back in January.
And what's really telling, I think, is why they did it. The Fed seems to be prioritizing, the signs of a slowing labor market. Right. Even though inflation actually hit a 7-month high in August. You had rising food, apparel costs.
So they looked past the inflation number.
It seems like it for now. It's a delicate balance, though they did nudge up their growth forecast for 2025 slightly from 1.4% to 1.6%.
And the signals going forward. Fed Chair Powell hinted more easing might be coming.
Yeah, he suggested October, December are possibilities. Projections point to maybe another 50 basis points this year.
Wow.
And the market's already, looking ahead, thinking about more cuts into 2026.
Okay, so connecting this to India, what does this Fed move mean for the RBI, for their monetary policy?
Well, the RBI has already been active, hasn't it? They cut the repo rate by 100 basis points cumulatively since February.
Right, including that surprising 50-point cut back in June.
Exactly. So this Fed cut now, it definitely increases the odds, you could say, of the RBI making another move, perhaps in October.
Even with India's own strong growth. I mean, 7.8%, a 5-quarter high, plus those recent GST cuts. Wouldn't that argue against an RBI cut?
That's a really good point. Domestic factors are strong. But the global context, the Fed easing, it gives the RBI more breathing room. Experts like Deepak Agarwal are suggesting this makes an October cut much more likely. It eases potential pressure on the rupee if they cut.
Okay, speaking of the rupee, what's the impact there? Usually rate cuts like this, you'd expect more foreign money flowing in, right?
Yeah.
Helping the rupee.
Typically, yes. You'd expect stronger foreign capital inflows, which should boost the rupee. But there's a complication. These ongoing trade deal talks and that pretty steep 50% tariff the U.S. has on some Indian exports that could really put a damper on those inflows.
So investors are cautious.
Seems that way.
Yeah.
Investor caution is definitely a factor. The rupee recently closed at 87.75 against the dollar, reflecting some of that uncertainty.
Now let's talk bonds. India's sovereign bond yields.
Yeah.
How does the Fed's move play out there? You said the signal of more cuts was maybe more important than the first 25 points?
Exactly. The 25 BPs cut was, well, mostly priced in. But the hint of another 50 BPs easing down the line, that's significant. Well, if U.S. Treasury yields trend lower, the gap, the spread, between India's 10-year government bond yield and the U.S. 10-year Treasury, it widens.
And that spread is already quite wide, isn't it? Around 240 basis points.
It is. So a wider spread makes Indian government bonds even more attractive for foreign portfolio investors, the FPIs. It's a better carry trade.
Meaning potentially more foreign money coming into Indian bonds.
Potentially, yes. Which helps support the rupee and can lower borrowing costs within India. Plus, another angle, cheaper U.S. dollar rates could make it easier for Indian companies to borrow money overseas again, reopening those markets.
Okay, but let's shift gears slightly. To really understand this Fed decision, we kind of have to look at the dynamics inside the Fed and the external pressure. It's hard to miss President Trump pushing for more aggressive cuts.
Right, that political dimension is definitely present. And internally, there isn't complete agreement at the Fed either. Well, their own projections show a split. You have 9 out of 19 members expecting another 50 basis points cut in 2025, but 6 think they're probably done cutting for this year.
So divided.
Powell himself said there are no risk-free paths. It highlights just how tough these calls are.
And then there was that dissenting vote. Stephen Miran, this is fascinating.
It really is. He's a Trump appointee, but he's also currently on the White House staff.
Which has never happened before, right? A Fed governor also working for the president.
Exactly. He wanted a 50 basis point cut, not the 25 they delivered. This dual role, it just raises serious questions about central bank independence.
Yeah, how do you maintain global trust when policy seems so well, tangled up with politics.
Yeah.
It reminds you of that whole situation with the BLS commissioner being fired over job numbers.
It's a complex backdrop. Ultimately, you could frame this Fed cut as what they call a risk management move. They're navigating this two-sided risk, trying to maintain full employment without letting inflation run wild, maybe even worsened by the ongoing tariff situation.
It's a lot to juggle.
Definitely. Economic realities under very visible external pressure.
Okay, so to wrap up our deep dive,
Yeah.
we've seen the Fed's measured cut, the pretty direct impacts on India's policy options, the rupee, bond markets, and then these really interesting, maybe slightly unsettling political dynamics swirling around the decision.
And that really leaves us with a key question, doesn't it? How do these external pressures, these internal Fed divisions, affect global trust in institutions that are meant to be independent? And what does it mean for financial stability down the road when economic policy and political influence seem so closely linked? It's certainly something I'll be watching closely. What aspects will you be keeping an eye on?